Well, this quarter we're going to have some fun. Last quarter took it easy on the recordings. It was so much uncertainty. We didn't do a lot of forecasting or show a lot of numbers. And this time we're gonna dive a little bit deeper in to some of those numbers and relationships. And I'll try to do my best to show you where some of this work flows into the portfolios, because we run maybe 30 different strategies. We have something for all market cycles. We have, the driver, the 7-iron, the putter, etc. Sometimes it's hard for me to show you exactly how we use this work to construct those portfolios, and each one of those portfolios is designed differently, and so some of them draw on different parts of this research, especially with the multi-manager portfolios. We are a manager within that, but then those portfolios also draw on several other people's opinions, and so that's good as well. All right, let's do a quick review. So at the end of the quarter, we have an economic cycle that we look at, and it's looking at, you can see here, there's 33.5 of those factors were kind of bullish, and 15 were bearish. So that leaves us a bullish score of about 68% on the economy. Okay, and so this changes. We do this frequently. We're looking at all types of data. Now, one thing to remember with that high score, if my score was 100% bullish on the economy, we'd be up here at this point C, right? Because that'd be all factors were bullish, and that's actually a bearish indicator, because if we're at the top of the cycle, although a cycle can stay up there for years, there's that backside to come, and so we may start to get more conservative. And then the contrary is true. If we were 80%, 90% bearish, that puts us down here at this new low, and most likely we're at the turning point for the cycle. So this bullish reading is pretty high, and the economy's been pretty strong, and so we kind of think that we're kind of here at this midpoint, skirting over. It hasn't materialized into a new low. Last quarter we were showing an arrow coming down here. There is still a chance that we have a recession in the next 12 months, but I don't think it's very probable. And we'll look at some more data and facts on that. So we still think the economy is still pretty strong. Obviously, there's challenges, and we'll recap this at the end. But based on our factor work, we're still bullish on the economy. Although at any given time that data could change, and we will update you. The other cycle that we look at is a market cycle. Now, this market cycle, guys, I think you should be getting this. We write about this frequently, weekly, monthly, quarterly, and we put a lot of data out, and so this is in written form as well. Right now, we are about 81% bullish from our indicators. Again, there is, as you can see, 64 factors that we're looking at to make up this market cycle analysis. Some of those are economic, some of those are fundamental, some of those are technical, right? So we're not just looking at one piece of data, we're looking at the preponderance of the evidence, a cross-section of the data to form our opinions. So again, at the end of the quarter, we still had a pretty high bullish score. Now, what's interesting is that if you look at the cycle over time, which is these blue bars here, let's see if I can get a pointer on for us. These blue bars, okay, you can kind of see that, and the gray line is the S&P 500. So again, when something gets too bullish, you can see that there can be pullbacks, right? And so it wouldn't be surprising to see a small pullback. We've had a pretty strong quarter. And so again, if we had a small pullback, we'd be not surprised. Again, a lot of you are familiar with technical indicators where you can be overbought or oversold. And so if that data point is mean reverting, and then you might expect that pullback. Okay, but again, 80% is a little higher reading than I would like. I'd really like to stay in that 50 to 60% range, kind of more in the middle, not get to such an extreme. But again, at the end of the quarter, and it's been such a strong quarter, we do have a high reading. When we move to the regions, It's no surprise that the international stocks have been doing well. You've had Latin America and Asia and the global, stocks ex-US, the ACWI, doing very well. A lot of that was in anticipation, right, throughout the year, and we'll talk more about this later, of the tariffs and what that might do to U.S. companies. So there has been a broadening of the investment opportunities to the global stage, where, for the last several years, it's been mainly a U.S.-centric stage, opportunities more in the U.S., and we'll come back and talk about that some more later. But again, great quarter for the Russell, almost 11%, but the international did outperform U.S. slightly over this last quarter. Now, when we look at the S&P 500, and this is looking, year to date, but we'll see here that earlier in the year, we crossed that 50-day moving average, right? We broke it here. And coming into April, there's that April 4th and that severe sell-off when we got into that, China fired back with that 150% tariff. And then we see that we've had really since that mid-April, that strong recovery for the rest of the quarter. And, right here, you can see that we broke above that 50-day moving average again. And currently at the S&P 500, we are definitely above all of the moving averages, at least from the 50, 100, and 200-day moving average. And so again, for year to date, strong return numbers, and in quarter to date, very strong return numbers. So this kind of leads into the supply and demand. So here we're looking, that was the S&P 500. Here we're looking at the Dow Jones and NYSE buying index. So you'll see here that we did break the 200-day moving average here briefly back there in April, right? That was a big scare. It broke that 200-day moving average, but as we saw, it quickly recovered and is now back above that 200-day moving average. Now, what's causing that, right, is an imbalance between supply and demand. Anytime that this red line is above, is above that black line, that is the sellers are in control. And if the black line is above, the buyers are in control. So you can see here that they don't have to coincide. Here we saw that we didn't break the 200-day moving average, but we did have the sellers, come into play. And so that's, that's a short-term, midterm, and long-term movement on the market. And we have to pay attention to all time frames, right? It's not just long or short. And we're going to look at that short, mid, and long-term perspective in readjusting portfolios. As some portfolios, can rebalance daily if necessary, right? A lot of those technical signals can go off in any day. Some portfolios are scheduled to rebalance monthly. Some are rebalanced quarterly. Some are rebalanced annually. And again, most of the tactical portfolios, even though they're set up on an annual or a quarterly or some scheduled rebalancing point, reconstitution, portfolio construction process, they could trade any day based on signals. So again, here we saw that imbalance switch here, but quickly, just like we got back above that 200-day moving average, you can see that the sellers quickly went away, and we're still back here with the buyers in control, and it's kind of widening right there. When we look at the sectors, for the quarter, technology, roared back at 22%. The S&P again about just shy of 11. Energy and healthcare, right, really kind of dragged those sectors down. And we'll see some weightings on these in a second. But the technology, really was the main driver there, and has done well year to date as well, even though, it was the first to fall apart in that first part of April. So, one thing to remember is that the technology is, about 34%, almost 35% of the index. Then you have financials, consumer cyclicals, and et cetera. So, energy only makes up about 3% of the index. And so although it was down considerably last quarter, it doesn't have a large effect on the overall index itself. When we look at your famous, or familiar style box for the quarter, here up to 630, we definitely see that growth was in favor. Now, there was a lot of talk that small cap should really perform well coming into the year before the tariffs. It's performed okay, but not relative to the growth. And we will see later on in the presentation that there, from a valuation perspective, the forward-looking valuations are really still in small cap stocks. Okay. When we look at The asset classes, okay, again, for the quarter, we saw large cap growth in the NASDAQ, international, emerging market, etc. You'll see I drew a red box around what I call those risk on assets. And what's interesting is that right now, the metals, which falls into the commodities space, which we'll talk about later, those, the metals, these are the pick, these are general S&P broad metals, silver and gold. They are really tracking in this red box. They're tracking with risk on assets, right? There are times where metals track with the risk off assets. And so metals and in particular, sometimes can be either a speculative play or a hedge. And so right now for last quarter, those metals have been in that risk on asset, and again, year to date, they've been performing very well. So, for those of you that want those metals exposure, or as we talk more about recommendations for commodities at the end of the presentation, we do have the Focus Metals portfolio. So, if you want some metals exposure, we do have a dedicated thematic portfolio that can give you that exposure. Okay, so we do have a way for you to play that theme. Down here in the green box, we see the risk off. Again, here we see commodities in general. We're down, and again, these are metals. Commodities are much broader than just metals, but they were down for the quarter. That Treasuries struggled a little bit. Again, mainly we see here this fixed income box, risk off assets that struggled, and so most of you know that makes sense because historically there's been a adverse or a negatively correlated relationship between stocks and bonds, and so or risk on and risk off assets. Risk on and risk off assets, and we see that happening last quarter. Let's move to the breadth of the S&P 500 and just kind of take a look and see what we have there. What we're going to see here on this chart is that at the end of the quarter, there was 305 stocks up and 208 down. Okay, and so we had a pretty good strong breadth, and we can see here that Plantair really led that charge, and Deckers Outdoor was the biggest loser. So you can quickly view here. Now, what's interesting is we don't have a lot of those FANGs or Meg 7s up in here, right? And so even though they had a great comeback, the market was having other participants, pull it up. And again, we don't see all the usual names here. So this is one of the quarters where the Meg 7 per se, it didn't really show up in the top or the bottom. A lot of the times they oscillate. You'll see Tesla, the number one stock, and then another period you'll see Tesla, the worst stock. So here we do have a little bit of breadth, and we'll talk more about that in a few minutes. So, are we overvalued? So is the market overvalued? Well, what we're looking at here is the forward-looking PE ratios of the S&P 500, so the market cap weighted up here, and then we're going to compare that to the equal weight. And so these lines here, this is average. The two green lines are a standard deviation 1 and 2 above the mean, and this red line is a standard deviation 1 and 2 below the mean. So you can see that on a forward-looking PE ratio, that the S&P 500 on a market cap basis is above its long-term average. Okay, and then the equal weight is just right about at average. Okay, so you've heard a lot of debate probably in the news and media about should you be equal weight or overweight, and so here this evidence shows that the overweight probably is going to happen in the equal weight, or the equal weight's more closer to average. Now, what do I do about that? Well, most of our portfolios are really stock picking, bottom up portfolios, so I don't really worry about this too much. It just lets me know, am I going to be more successful? What environment am I going to be prevailing in? And do I need to do more work? Because even though we look up here and saying that the cap weighting is over its average, I can still pick through and find small cap, mid cap, large cap companies that are in the right sector or that are rotating. So I don't give too much credence to this, but it's a good talking point just to kind of understand that the market on a forward-looking PE ratio is above its average, and the equal weight is just right about average. Something that I care a little bit more about is what I call the equity risk premium, or it's not what I call it, is the equity risk premium. I didn't invent it. The equity risk premium is the amount of return that an investor or the market in general is going to require over a risk-free asset. And so right now it's really low. The way I calculate this that 3.71%, is I use a discounted cash flow analysis. So it's like when we value a company, we're valuing a stock. So here I'm valuing the market. And what I do is I say, well, if the market's at 62.29 right now, what does the equity risk premium have to be to make it fairly valued? And so you see here we have this zero check. So the model that I solve for matches the current index of the current value of the index. And so in this fashion, I reverse engineer the required rate of return for that implied equity risk premium. Okay, so with the equity risk premium of 3.71%, if you add the risk-free rate to that, you can see the total expected return is about 7.71% based on this model. Now, if you look at the consensus analyst estimates from Bloomberg, they're about 7. Okay, so we can see that. So the model, forward-looking is pretty close to the analyst estimates. Again, as an analyst, this is how I would calculate and contribute my number. This is a consensus of all the analysts out there, right? So some are going to be higher, some are going to be lower, but we do all of the calculations ourselves and run the models, and so we have a pretty good handle and understanding of what's going on. Now, what's most concerning about this equity risk premium relationship right now is what I have circled up here, is that the market is really priced in. It's got everything priced in. If you can see that if the equity risk premium goes up to 4, okay, or even 3.75, that we end up with an expected return that could be negative on the market. So we're really right at that line. This is something that we're paying a lot of attention to. It's nothing I can control. And again, with stock picking, I can work around this, and that's why we like focus investing, is that we just don't index and take whatever we get. We can take this type of data and analysis and apply it in a more thoughtful and meaningful way, and hopes to give us a little bit of edge in our portfolio construction. So again, some of this is hard to put into a direct action, but this is, again, leading me away from just indexing and blindly buying a bunch of stuff. I'd much rather be focused and meticulous about our security selection, and this is just how I form some of my views on that. Okay, to continue this theme, we'll go and look at an earnings expected returns model. Okay, so again, we take some fundamental data and we calculate an expected return. We put in the dividends. So here we have in this model an expected return of about 7.5%, including the cumulative dividends. And then we run a data table on it. And you can see here again, there's a lot of sensitivity here. You can see that at a growth rate of 9 and a PE of 24, that's where we get that 7.5% expected return. So here again, you can see that we have that 9% growth rate, a PE of 24, and we get an expected return of 7.5. So how we read this table is if you think that the market can do a long-term average of about 6, but it's still going to have a PE of 24, then we're going to expect about 4.5% return on the market. If you're like, no, I think that PE on the market should only be 18 and a 6% growth rate, well, then we're in for a negative 20% expected return on that relationship. So all you have to do is you match up the growth rate with your expectation of your PE, and you can see what that expected return might be. Okay, now there's no guarantees of this, of course, but these models, and since we run these over and over and over, give us just an understanding of how to fly the plane or where we might be in the market cycle, and should we be leaning in recommending more of our portfolios that are closer to indexes that trade once a year, or are we expecting to be more active? And so again, this is just a piece of evidence that we look at on the valuation side. On this slide, what we're looking at is the equity call volume. And so, an equity call volume, if you think the market's bullish and it's going to go up, you're going to buy calls. And so when we measure the volume of the whole market, we can see are the market participants putting on a bet that the market's going to go up or down. And so right now, at the end of the quarter, we're right about average. Okay, So we're right about average on the call volume, which is fine. That kind of puts us, we're right at basically an expected return of 7%. That's basically a long-term return of the market. So we're not really underweight or overweight. We're pretty much neutral and an equal weight at an index level. So this isn't surprising, but again, you can see how this ratio goes up and down as we cycle through. So you can see down here, we got to a low point down here. We hit a high point. So again, it's just something this changes frequently, but it kind of gives me an understanding of what market participants with live money are doing. Remember, this is price discovery, right? We can listen to pundits on TV or myself and make, talk about what we see, but this is live betting, right? This is live money expressing a view. And so we look at this call volume. We're also looking at the put call ratios as well. I'm just not showing those right now. Okay, let's turn to the economic indicators. And so many of you have seen this chart before. I'm going to look out. If I'm going to look out of the windshield of the car, we're going to call that the leading indicators. And so this green section, this green panel up here, is where we're going. This is the leading economic indicators. And again, you'll notice that they've been negative for quite some time. Now, in the past, when they've turned negative, we've had this red bar recession. Here, they've turned negative. We had a red bar recession. Excuse me. Here, they turned negative. We had a red bar recession. So far, we've skirted that recession. Okay, and we'll talk about in a few minutes, should we have a recession or what's going to happen there? But we don't know, right? It's been a long period here of having these negative leading economic indicators. Then the blue panel is kind of, if we're stopped at the stop sign and we're looking out the side of the car, this is where we're at right now. These are the coincident indicators. And again, you'll notice that they're all positive right now. And then here we have the lagging indicators. This is looking through the rear view mirror of where we've come. And you'll notice back here that from prior recessions that the lagging indicators don't even turn negative until after the recessions happened, right? Here we can see the recession is kind of over and those lagging indicators turn negative. Again, we see that here. So right now, we definitely don't have any lagging indicators that are negative. They got really close to zero here, but they're hovering still in that positive territory. And so, we're watching these closely. It doesn't mean that we have to have a recession, but this is some data that might lean you towards that. Coming back to this chart, this last panel here, this is the road that we're on. This is what got us here, and that's the Federal Reserve. So again, you can see the rate cycle. Rates were high, they lower them, they raise them, they lower them. And here is that longest business cycle in history, right, that I can remember. So on my prior chart where I said, if all of our indicators were at 100% bullish on the economy, that would put us at a new top. But that top can stay there for a long time, right? The Fed stayed at this top for a long time before it changed rates. So we don't know how long that top or bottom of the business cycle is going to last. It's usually closer to 2 to 6 years, but this was an extended period. So right now we know that the Fed has raised rates rapidly. They brought them down a little bit, and they're kind of on a pause, and we'll talk more about that. So again, the road that we've been on is this Fed rate cycle. And again, we have negative leading economic indicators, and we still just have to watch this data. Okay, on this chart, now we're going to look at out of the windshield again of the economic card, and that's the forward-looking data. And that's going to be the ISM indexes, right? The manufacturing and services indexes. These are done by survey. And so these are telling us what the supply chain management CEOs and businesses are thinking. So it's kind of a look into the future. Anything above this red line is expansionary. Anything below that red dash line is contractionary. And so you can see here that we're just hovering right about at that average line. Now, you can notice that, again, if we come down here, this orange line, the Fed rate cycle, you can see that, here, economic activity dipped. We had this recession, so the Fed then decided to lower rates. We see this expansion happen. Expansion was this long expansion growth. We started to overheat, so they raised rates. They broke the economy. We had a recession, and so forth. They lowered rates, okay? kept rates low, and look what we had. We had a very long expectation of good economic activity and so forth. This middle panel is looking backwards like the rear view mirror. This is GDP quarter over quarter. And so again, we've had some pretty long period of positive GDP growth there. This white line here is the market. And so you can see that the market, it's been going up, even though the Fed's paused. The market is still anticipating that the Fed will either stay low or cut, and that we're going to avoid a recession. Now, that doesn't necessarily mean that happens, but we could. So leading into a recession is, what are we going to look at? There's lots of tools out there, and we put out several economic pieces, some simple, some more complicated. But this is one chart, if I had to sum it up, I would look at, and that is the relationship between unemployment and recession. So this green line is the actual unemployment rate, and the blue line is the change in unemployment. So there isn't a unemployment number 4, 10, 5 that causes a recession. In fact, you can see here inflation was about 4.1 here, a little bit lower, but these green lines, it's not the same on every recession. But what is the same is the increase in the rate of that data, the increase year over year of the employment rate. And so when we go from 0 to 1, we see recession 0 to 1, 0 to 1, 0 to 1, 0 to 1, 0 to 1. So that is a little more predictive than the raw data itself. So that raw data has to be transformed and smoothed to get a more predictable and reliable picture. And so again, here we can see that that unemployment, the rate of change on unemployment is pretty flat right now. So again, if this starts to spike up and gets up closer to 1, then I would be much more inclined to think that we could be seeing a recession over the next 12 months. Now, if we look at survey, if we look at all the contributors to Bloomberg, currently at the quarter, there's only approximately a 35% of a recession over the next 12 months. And so here we can see the median's 35. You can see the high is 60, the low is 0.4. You can see the distribution there. So again, I don't think that the community is overly concerned with a recession over the next 12 months. But again, we have to wait and see. Okay, what drives the market? So again, there's bull markets and there's bear markets. What drives those markets are exactly the same thing, but in opposite directions. So the primary factors that are going to drive that are inflation, interest rates, corporate earnings, the Fed, and geopolitical events. And so right now we can see that inflation is close to the Fed's target, but the tariffs are kind of weighing in on that, right? So there's uncertainty. A lot of the Michigan studies show that inflation over the next year and over the next few years could be rising, but those are forecasts based on the analysis of the tariffs effects, and we don't have a lot of reliability in those models yet, so we're still waiting to see. But again, it is low, it has come down, but that tariff is causing some uncertainty in what it might do. The 10-year bond, there's been kind of a battle between flight to quality and higher inflation expectations. And so what I mean by that, and we put a little bond piece out on this a few weeks ago, is that, when there's a lot of geopolitical events, there's a lot of times a flight to quality. So if there's a flight to quality, that means everyone's trying to get into bonds. And if everyone's trying to get into the bonds, supply and demand, that means bonds are going to go up. It means the prices are going to go up. It means yields are going to go down. Now, what we've been seeing that the expectation of inflation, is actually doing the opposite, right? So people have been rotating out of bonds. So there's been less demand for bonds, prices going down, and the interest rates going up. Okay, so there's kind of an inverse relationship there. And the other factor, observation that I believe is happening is that there's been a large rotation to equities. And so if there's more money in equities, there's been less of an effect on the bond market, even when we have had a flight to quality, because there's just not enough people there's not as many people flying to quality. Therefore, the supply and demand is out of balance, and therefore that higher inflation because of the war, Israel war, and the oil, et cetera, those inflation expectations, I believe, have been weighing on the bond market a little bit heavier than the flight to quality. That can change rapidly. Corporate profits, they're above average growth rates, and they've been very resilient. But again, uncertainty remains. That's really hard to model from the tariffs. So we're going to have to wait and see, and we'll look at some more earnings expectations in a second. The Fed, obviously, we've all read that the administration is pressuring the Fed to lower, and right now they're holding stable and being data dependent. But again, we just have to, kind of follow the Fed. We can't outsmart the Fed. The markets and the cycles are really led by what they do. So right now they're holding stable. I think that the probability is very low that we're going to have a July rate cut, and then we'll have to reassess them. So that maybe we get one this year, right? If they did, maybe we get one rate cut this year. Geopolitical events, man, every year, every decade, there's always something going on. Geopolitical events, we really can't handle those as a portfolio manager as well as you can handle them as a financial advisor. And what I mean by that is that you have to have your parachute, you have to have your financial plan established before a geopolitical event happens, right? I can make adjustments to a portfolio, but if a black swan hits, I can't, the market's going to fall. I can't make adjustments fast enough. That's why you need to make sure that you have a well-diversified plan. You need to have some cash, some annuities, some, at-risk money. That's really what's going to save the client if there's a black swan or a geopolitical event that was not something that we saw coming and we can't really model. Now, we will do our best, of course, to react. But again, proactively, you're going to help your client through a solid financial plan. And then I'll do the best I can, and the managers will do the best they can with each individual portfolio mandate. So again, there's no shortage of geopolitical events right now. The tariffs are still probably weighing the most on the market. We got a new tax bill. I have not analyzed the tax bill yet. It's still so new. I'll get around to that. Again, this is quarter end. Next quarter or next in August, we rebalance a lot of the models. So I have other things that I really need to pay attention to other than the tax bill, but I will start to incorporate that in over the next 30, 60, 90 days or by year end. And then, of course, those military conflicts. And so plenty of geopolitical events, plenty of reasons to make sure that your clients have a good amount allocated to annuities and the cash, and then let their red money, their at-risk money, kind of do what it's supposed to do. When we look at corporate earnings, right now, the trailing 12 months was 254 on the S&P, and we're looking at 260. You got a little bit of growth there. It's probably going to be a little bit more than 2. It just depends. But you can see here that the minimum range here is 245. The highest estimate we have is 275. On the median estimate is that 260. Again, that blue bar represents the 25th to 75th percentile on a probability distribution. So earnings are okay. And we're just, again, we have to wait and see what these tariffs do, but they've been resilient and they're still positive at this point. And again, the tax bill, could have a very positive effect on them. And again, if we skirt a recession, we would expect higher earnings. And if we don't, then we are going to expect those earnings estimates to come down. All right, let's just look at some fun market factors. What we're looking at here on the top chart, the blue line, this is showing that high yield bonds are in favor over investment grade. And so this gives us another really good tell on the macro environment. If the market's really worried about risks and they're having that flight to quality, we're going to see that that blue line is going to be pointed down and that treasuries are going to be prevailing. And right now, because the blue line is kind of pointed up and it's above its moving average, we're still seeing that those high yield bonds are in favor, and that is no surprise because we've had a strong quarter and they're going to track risk on assets better than they track risk off assets. But again, this is another way that we can make that relationship and pay attention to it. On the bottom line, we're going to look at large cap over small cap, and again, we can see that the large cap companies are prevailing over the small cap companies. And there was a lot of chatter at the beginning of the year that the small cap companies would be having a really good year. That hasn't happened yet, but we're going to show you some evidence that there is still a ton of value available in those small caps. When we look at growth versus value, you can see that the bottom panel there, that anytime that we have growth over value, right? The numerator and denominator. So if this is going up, that means growth is winning, and we see that happening. You'll notice that here in April, right? We had that little scare in the beginning of the quarter, the beginning of the month, or the quarter of April, beginning of the month of April, that we saw, that value kind of come back in favor very shortly. And then, for the rest of the quarter, that growth prevailed over value. Kind of the same story with momentum versus value. Really, that momentum has been in favor for the majority of the quarter. Again, that early April, we saw that value come back and momentum kind of wane just for a couple weeks. But then we finished the quarter strong with momentum being in favor over value. And when we look at the U.S. versus international, we can see that the U.S. has definitely been in favor for the year and for the quarter. However, we did see, remember we talked about this earlier, that the index, the global stocks have done pretty well, looking at that at the tariffs, right? And so the more tariff talks we have, the international stocks were doing well. Okay, but again, at that beginning of April, they did well. And once we started to recover, we saw that the U.S. started to outperform and starting to come back. So now the way we play this is we do have a focused international portfolio. It's done very well. So if you want portfolios that have pure international stocks, we have a great option for that. Again, a lot of our portfolios will have exposure to international stocks, incidental via the process, but not as a sole thematic portfolio. And so we will be looking at that, but we do have a portfolio that's 100% international. Now, when we look at going forward of where international might be, this chart is what we look at. This is taking the forward-looking PE ratio on the ACWI All World versus the S&P 500, and you can see that there's a lot of value. Being down here means that there's value in the international. The value advantage is to the international, and we're down here, below a standard deviation, below its mean. And so again, if there's a mean reversion process, we're going to see that there's a lot of international value to be had. So international has done pretty well over the last quarter. In general, the last several years, it's been in the U.S. market that's prevailed. But there's a lot of value in international. We would suggest you take a look at that. We come back to market weight versus equal weight. Again, we're going to see that capitalization weight is trending. Equal weight is it's going to oscillate, and we'll show you that in the next couple charts. But again, there's some oscillation here, even though there's some trend. So it's kind of a fractal market. But currently, at the end of the quarter, the capitalization weight index is working, and we'll pay attention to that. Now, for a lot of clients, they don't understand what market cap and equal weight is. So we just put a quick example in here. If I was explaining this to my kids, I would say, well, there's two choices. A cap weighted index is made up by the index provider, and each company in it has a different weight. So here we see 25, 20, 15, 12, etc. Adds up to 100%. On an equal weighted index, everything is the same, right? It doesn't matter. And so obviously the cap weight bias is that in this example, two stocks make up 45% of the index. And so if those two stocks do well, you do well. If they don't, you don't. We're here, they're less impactful. So this was just a slide to help help clients understand the difference between a capitalization weighted and an equal weighted index. What I'm looking at here is we're looking at several different periodicities from year to date to 52 weeks. We're looking at sector by sector, and we're looking at equal weight versus cap weight. So jumping down to the market, you can see that the market weight that's in green, okay, it's been 5.9% for the year versus 5.3% for equal weight. And so you can go back and see what was prevailing at each different period. So again, here we had equal weight, here we had cap weight, here we had cap weight, about equal, cap weight, and just about equal. So what's I think more interesting to me is that different sectors, right? You might have like here, the basic materials is a cap weighted advantage. And then we have communications equal weighted, consumer discretionaries equal weighted, financials is market weighted. So when you pull back and see what's going on in these companies, you can kind of get a better understanding once you peel back that layer of the onion of what's going on. So for example, in the energy market, the XLE per se, I think Chevron and Exxon make up, about 40% or so of that index, or a very high disproportionate amount. And so if those two companies are doing well, we're going to see the index doing well. So again, what does this tell me? Well, I like to have concentrated stock portfolios because I think I can do a better job of picking that than just picking the whole market. But this will give us guidance into, sometimes we want 5 stocks in our portfolio, sometimes we want 25. So this will give me an idea of how many stocks we might be expecting to put in the portfolio, and should we add more? This will also let me know, should we be just using focused tactical equity for our equity exposure, or should we add dividend and value? Should we be more diversified in our approach to taking that equity exposure? And so these are just some of the data that I look at that helps me give you advice on how we should be positioning portfolios. Okay, I don't expect you to remember all this. That's what I'm here for, but hopefully you find some of this interesting. Okay, our outlook is still pretty much cautiously optimistic. I mean, that bull market, I'm not ready to go all bull or all bear yet. Things are looking pretty good, but there's still those geopolitical risks in the Fed and all the other data out there. So we're still pretty comfortable being, 50-50 risk on, risk off, and kind of waiting and seeing. We have to be patient, right? So we think that is a prudent way to do that. Again, what I'm looking for in general as a chief investment officer is I'm looking for reasonable returns over reasonable time periods, for reasonable people. So reasonable risk-adjusted returns. So our outlook here, inflation, again, as we talked about, continues to come down, but the risks remain because of the tariffs. Again, don't fight the Fed. The market isn't, I don't think, expecting a rate change in July. We'll reassess. Maybe we get one later in the year. Interest rates, the yield curve is positive, which is great. The reason I put wait and see in here is that recessions usually don't happen until the yield curve has reshaped, right? Is gone back to a positively upward sloping shape. And so, just because it's positive doesn't mean that we couldn't see a recession happen. So we're just kind of waiting and seeing on that. There's increased opportunities in this active management, of course, and asset allocation and stock selection, but patience has to be deployed. So again, in focused tactical equity, there's some stocks in there that are, some of those Mag 7 or larger growth stocks, tech stocks that might not have been performing very well. We're not going to just abandon them. They're the world's best companies. We're going to be patient with them, even though it might mean underperformance for a quarter or so. Doesn't really bother me. We're really looking, for long-term performance and a risk-adjusted return and a high, if we get the higher the Kalmar ratio we can get, the better. Now, risk management has been popular again because of the tariffs and the new administration and the political divide and the geopolitical events. So risk management has definitely been the talk of the town and has become popular again. But V-shaped recoveries, right, can be an issue. It's really hard when the market goes down so fast and people panic and they want to get in and be more conservative. As soon as they do, it turns around and goes back up. And so that's why sometimes you just got to be patient, and we can't try to time the market within our portfolios. We need to use the financial plan again as that parachute. So have some cash, have some annuities. Therefore, we don't have to over manage the at-risk monies, right, at your level. I will manage them obviously continuously as most appropriate, from my opinion. Okay. Fixed income is entering a favorable yield. So yields are coming up. They've been pretty high, but volatility remains, and there's still that battle between a flight to quality and inflation fears. And so again, if rates go up because of inflation fears, bond prices are going to go down, but people that are wanting to get into fixed income are going to have a really nice opportunity to enter the market and get some really nice yields. Again, we have an individual bond portfolio, a focused bond. And remember, the advantage to that, guys, is that I don't care if rates go up or down, because if I hold that bond portfolio to maturity, I know what I'm going to get. I've eliminated a lot of that interest rate risk, and I'm mainly taking on default risk. Okay. So right now, and we'll come back and talk about this in a few minutes, but right now, we're not worried about individual bonds, and I don't have to worry about rates go up or down. What we're looking at here is just a fundamental factor ranking. So we're looking at the forward PE, the growth rate, price to book, debt to capital, and right now that would say that energy is the number 1 ranked sector, telecoms and materials. Again, this kind of makes sense that energy is ranked number 1 forward looking. There's the most value there because it was the bottom performing sector for the last quarter. And so again, when something goes down, it provides potential future value, and that's what we're seeing from a multi-factor fundamental ranking model. Okay. Moving on to looking at some various equity returns. We got the S&P 500, the Russell 1000, Dow Jones, Russell Growth, Value, NASDAQ, Mid Cap, Small Cap, World, and Emerging Market. You'll see what the expected consensus returns are for those asset classes. And again, you'll see that small cap Russell 2000 is circled. That has an expected return of about almost 23% in it. Again, no guarantee that any of these returns come true. These are just consensus estimates. But that is where the value seems to be. So it hasn't materialized yet. That's why if you're playing small caps, or if you got into small caps, or if we get into small caps at the beginning of the year, we're going to have to be more patient with them because that story just hasn't come to fruition yet. Okay. But again, the long-term average return in the market is about 7%. We're seeing that here. Now, to cross-check that, what we can do is we can look and see what the estimate ratings are of the stocks in the S&P 500. So what we're looking at here is that out of the 503 stocks, there's 269 of those are on buy rating. So 53% of the S&P 500 is on a buy rating, and 46% or 233 stocks are on a hold rating. Okay. And so what's interesting here is that that's a pretty split market, right? That's pretty close to 50-50. And again, what we're trying to do with active management is, try to pick from these 269 stocks. If you buy the index, then you get half good, half bad per se. So again, we see that 7% return, and it's done well looking backwards. If we're looking at a consensus price target for the end of the year, it's about 6,000. So it'd be just a small pullback of about 4% between now and the end of the year. At the beginning of the year, our estimate, and we were about in the middle of the pack, was about 6,500 on the S&P 500. So you can see that the distribution range here is the low is 4,500, the max is 7,000. And here's the blue range is the 25th to 75th percentile, with that 6,000 being the median. Okay. What happens, who knows, but that's just where the analysts have the growth rates and the targets between now and the end of the year. Now let's turn to asset allocation. What we did here is I ran 5,000 Monte Carlo simulations against a maximum Sharpe portfolio. So I take an asset allocation model, and we have 5 different asset allocation models, and it doesn't really matter which one. This is just think of it as a max Sharpe ratio, a moderate portfolio. It could be any of those portfolios per se. So if we run 5,000 Monte Carlo simulations, what happens is we get a range of negative 10.5% to 20 to almost 23. So let's say negative 11 to 23 to round off. So 90% of the time, that's where your client's return is going to fall if we're following an asset allocation approach. Is down 11, up 23, and on average, right, the mean is that 6.164. So on average, right now it's about 6%, which is a little bit higher than the last few runs that were closer to 5.5%. So that's what you should be expecting with asset allocation models, is about that 5 to 6% range 90% of the time. Of course, you could go down 20 and be in the tails, or of course you could go up 30 and be in a tail, but 90% of the time you're going to be living in this space right here, down 11, up 23, on average 6. Now, one of the things that I've been talking about for a while is that, if I can get you a gross return of 5% in a bond portfolio with very low risk, with a duration under 4, and it's investment grade or better, and it has a coupon of 5+, there's not a lot of risk there. So, maybe you want to look at using individual bonds instead of asset allocation. Again, you're going to get on average at least 1% more on an allocation model, but there's a chance that you go down 11 as well. there's a chance that you get 30. So there's a lot more uncertainty in a asset allocation model. So if you got clients that are using allocation because they want it as a risk-off asset and they're looking for more of a stable return, you might want to consider using the individual bond portfolio where you're getting a higher probability of that 5% return. So it's just probably a safer way to get that return. Also, I love fixed index annuities and portfolios. Mathematically speaking, they make sense most all the times for most investors, and not for all investors all the time. But this, again, some people think of bond portfolios as a replacement to annuities. I don't really. I mean, I talk about that in the book I wrote on annuities, but an annuity on a point to point is going to get you 5% maybe, but it's not going to give you that current income. So a bond is going to give you some current income. Those coupons are paid every 6 months, so you're getting that yield, that current yield. You're getting that coupon of 5% coming into the portfolio, where you may get more or less in the annuity. Okay, so I would just challenge you to think that annuities can complement. The bond portfolio can complement annuities as well. I don't think you have to think of them as a zero-sum game where, I either use a bond or an annuity. I would challenge you to say that there's many times you should use both together in concert, and it's going to really make a nice complete portfolio. So the last slide I'm going to talk about here, just some very high-level guidelines for where we're at in the cycle. So where we're at right now for a conservative investor, you might be wanting to look at about 30% stocks, 50% bonds, 20% cash. For a moderate investor, you got 70% stocks, 10 bonds, 10 cash, and 10 commodities. Again, if you didn't want to use commodities, then you'd see that would be 70-30, kind of that stocks and bonds, a little bit over that 60-40 portfolio right now. And again, this can change, right? At one point in the cycle, we might be 60% stocks, 40% bonds and cash. So again, if you want the further diversification, you could use the commodities. Now, commodities, gold and silver has been doing very well. The focused metals portfolios have been doing very well. Commodities, however, do have more cyclicality to them, right? And some advisors, just don't want to put them in a portfolio or pay attention to it or make changes. Totally understand that. So if you don't want the commodities exposure, then just eliminate the commodities and split that between bonds and cash. For an aggressive investor, where we're at in the cycle, 70% stocks, no bonds, 10% cash, and then it's a little heavier on commodities because it takes a little more risk, but you're getting a lot more return. So again, silver and gold have done very well. There's times that they don't, right? They're going to come in and out. And then the diversified metals. So the metals portfolio is something I would recommend looking at for your commodity exposure. Again, it is more metals. It's not going to have grains and oils and other commodities in it. But the metals have done very well, and it's a good commodity replacement. I really like, for that moderate investor right now, that really kind of that 50-50 allocation, I think makes sense. And then you can tilt them up or down from there. I think using a multi-manager portfolio or an allocation portfolio or a bond portfolio as a core, and then wrapping risk around that's core satellite, still makes a lot of sense. You can really control how much risk and return you're getting a client by using that methodology. And so, of course, call us and we'll go over any portfolios specifically or talk more details. And again, for further details on any portfolios, you can refer to the tear sheets or give us a call and we'll go a little deeper.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.